Oh, I don't know what just happened. There we go. All right. Welcome back to another Pear Does. Still doing Chainlink. Just pulling up some stuff real quick for y'all. Your channel. How do I edit the live? Okay. Okay. Much better. Much better. All right. Well, welcome to the channel. Okay. Just making sure. Okay. Real quick. Much better. Much better. All right. So. All right. Well, welcome to the We left off yesterday. Welcome to the channel. Okay. Talking about how Chainlink operates. We were reading through some of their documentation and actually went through how Gemini was describing them. But coincidentally enough, something popped up on my phone the second we stopped streaming. And that's this article that you see here. Trump crypto project taps Chainlink for on-chain data. And so regardless of what the project is or what the project is doing, I think if we're thinking project agnostic, it's super nice, super cool, super foretelling to see that, you know, these crypto projects, one that, you know, the Trump family has backed, using Chainlink for on-chain data. And so we kind of can go through here and see what that project is, but how they're using Chainlink is really what we want to get to the bottom of. So World Liberty Financial, WLFI, is a DeFi, decentralized finance project backed by the Trump family, and they announced the adoption of Chainlink's Oracle service. If you recall, Chainlink is the decentralized Oracle network, whereas Link is the token for that Oracle network and how those oracles talk to either one another or to the contracts that they are talking to. President Trump has launched WLFI with plans to offer borrowing and lending services for cryptocurrencies on the Ethereum blockchain while also paying liquidity providers. Then in October, the project submitted a proposal to the governance forum for Ethereum, to the Ethereum DeFi platform Aave. Aave is a lender of sorts. So if you've never used Aave, you can go to Aave. You can either put up assets to lend out. So if you had a bunch of ETH, let's say, and you wanted to lend some out, you would go to Aave, and they would be the ones to connect you with other people that want to borrow Aave. You wouldn't have to know them or connect with them at all, but you're simply putting up those assets, and they would find someone who would then borrow those assets. Obviously, you would earn a yield for this. Once they did that, Trump and his business partners intend to build their crypto offering. The ambitions of the project seem to be shifting too. Late last month, there were talks that the project was interested in launching a native stablecoin. A stablecoin is something that is parity with another fiat currency. In most cases, however, when people say a stablecoin, they are referring to a stablecoin that is parity or the same as the US dollar. So this would mean one of those stablecoins would equal one US dollar. You might be asking, well, isn't that always the case? Isn't one always going to equal one? It's not. It's a lot harder than you think. It's not that they can just say, okay, one of these is worth one US dollar. In a closed loop, sure, you could tell everyone to make this so, but how do you get people to believe that? Well, you back it by something. For example, USDC, US dollar coin, owned by Circle, made by Circle. They back their USDC, their US dollar stablecoin by short-term assets such as government bonds, cash, and other short-term assets. Developers plan to integrate Chainlink's Ethereum price feeds into World Liberty Finance Aave 3 instance, pending approval from the World Liberty Finance governance platform. So basically this is saying that the developers of WLFI are using a fork of Aave 3, and they want to use Chainlink to bring in the prices of Ethereum using Chainlink oracles. As we know, these oracles can go out and get price feeds either off-chain or on-chain. So WLFI could use this to go get the information of ETH price from other chains, from centralized markets, from other DeFi platforms, you name it. This integration is meant to provide WLFI with real-time on-chain financial market data, which is essential for its operation, the company said. Chainlink's price feeds have seen widespread adoption in the DeFi space. And then it just goes on a little back and forth here about how they're collaborating. Early in September, statements by the team behind WLFI suggested that the DeFi platform aims to maintain global US dollar supremacy through the use of stablecoins. This is super important because we know that the US dollar in a global sense is losing its power. And by losing its power, I mean losing the value in which people look at the dollar. This is clearly demonstrated, and if you ever look at the US dollar versus the euro, this isn't something that's new, but the euro is worth more than the dollar. To figure this out, just go look at the dollar to euro exchange rate. You have to pay more in US dollar to get 1 euro. I don't know off the top of my head. I would assume it's something like $1.06 or $1.10 for 1 euro. But that's showing that you need more dollars to purchase the same amount in euros. And so what this means is that the value on a global scale of the US dollar at a relative weight is worth less than other currencies. Now, this doesn't mean that the US dollar is worth less overall. There's other instances where the US dollar is used as the finalization currency, right? This is how global entities, countries transact. The US dollar is how many countries buy oil. But you can clearly see that the US dollar, even on a country scale, such as other developed countries, is not the same. They're not one-to-one, nor is the US dollar worth the same as it did 100 or so years ago. And that's, not to blame the US for. That's just how fiat currencies grow. That's just the life cycle of a fiat currency. But this is another stablecoin project, and a lot of these stablecoin projects aim to either A, bring US dollars on chain, and then B, help promote the strength of the US dollar, because once it's on chain, it can be used by anyone, anywhere, without the full-on mint, print, and consent of the US government, making sure that everything is trading hands accordingly. All right. So now that we're done with this one, I want to move over to the article of the day. Let's go here. Right. So this is another article done by Chainlink, from the Chainlink blog space. And I just wanted to download this here and show you guys the title before we dive into that, right? So bringing capital markets on chain with DTCC and Chainlink. This is another instance of how Chainlink is interoperating with the current infrastructure of the banking and financial system. So this is going to show another real life use case of how Chainlink is being utilized. But before we even get there, we did have a question yesterday from Karen on, what's the price of Chainlink? What's to be expected? What's it supposed to look like this bull run? To be honest, that's not something that I like to touch on a lot because you can't really predict the prices for these things. But what we can say is that the more people, the more developers, the more applications that use Chainlink, the more that we can expect Chainlink to be purchased on the market, because Chainlink will be needed to be used on these cross-platform use cases to be used to go get the data from these link nodes. So take a look at this graph real quick. For those of you that are on the shorts, you can't see all of it. I highly suggest going to the live stream on YouTube as well, the full live stream. But what we see here is the real-time volume, the market cap, the all-time high, and the cycle low. So the all-time high and the cycle low, the all-time high is just simply what's the highest this has ever been and what's the lowest this has ever been. The all-time high is sitting at $50. The low is sitting around $5. Again, these are nice to look at. They're pretty. They're cool. They tell somewhat of a story that there was some fluctuation in the price of Chainlink at some point in time. This is what that would look like. You can see this spike. And on the right side here, if you see this dotted line, right now the currency is right about $13 right there. And so what this tells us is that there is a market for Link. People are buying Link and selling Link. And to be honest, they've bought and sold $400 million worth of Link, as we can see by the 24-hour real volume. Excuse me. But another thing that we want to look at here is all the way at the bottom, we can see similar projects, right? So similar projects are these other Oracle networks that we know that are out there that people can be using, but either are not, or they are better on other chains. And we can see that the value of these tokens, the Pith network, UMA, and Band, I haven't heard of Teller. Teller's a little high here, but we can tell that these are newer projects, or they have more tokens to be able to maybe attract more customers, maybe attract more developers. You don't necessarily want a super expensive token, because if Chainlink oracles are charging for total tokens, like they want full tokens, one link, that would be $13, whereas a Pith would be 41 cents. But it's up to them how they want to charge and what they want to charge. So I'm not going to fault the price too much, because at the end of the day, if it is about the price of Link and not the actual amount of Link, they could charge as little as 0.1 Link for every transaction that they encounter. Likewise, this is the Dune Analytics dashboard for CCIP. If you recall, CCIP is cross-chain interoperability protocol. We can see here that this is a nice diagram over here about how CCIP operates. You have the end user who submits a request to a DApp or a smart contract, which then messages the Chainlink oracle or router. And then there is a lot that goes on within the CCIP protocol. So you have a message, you have data, and you have tokens. And this is where CCIP really comes into play. Because what happens if I'm on Ethereum and let's say you're at a bank and you want me to send you 10 ETH? Well, number one, as we recall yesterday, you can't talk to that bank unless that bank is on the same network, which 9 times out of 10 it's not going to be right now. So you need a way to communicate with the bank, which would be the data, but then also you need a way to transfer those tokens. How would the Ethereum blockchain know that those tokens are no longer on Ethereum if I send them to you? Let's just assume it's a bank's personal chain or bank's personal network, right? How do we know? And so you're actually sending these tokens cross-chain by, number one, locking them up in a contract on Ethereum, and then sending them to this other chain with the bank. And so that's where you see this other use case of router than or this end state of router to DApp to other end user. More so on the other side of the equation, you can see here what this looks like to send a message between chain X and chain Y. Similar situation that we described above, but again, you can see here to send messages between chain X and chain Y, you have the cross-chain application and Chainlink's messaging router contract. You have the application going and retrieving or requesting the data. You have the messaging contract working with the Chainlink Oracle system to send the tokens, to send the data, to send the message to chain Y. It goes through the Oracle network, bada bing, bada boom, and then the information is disseminated the same way that it was sent. You have the messaging contract, you have the cross-chain application, and then chain Y receives the data and tokens from chain X. Okay, now if we go back, put this back in the middle. If we scroll down here again, this is only for CCIP. This is not for all of Chainlink and Chainlink's Oracle network. We're not going through, we're not saying, okay, well, how many people are using Chainlink? How many tokens have crossed through Chainlink? What's the link purchase and sell cycle? No, right now this is just CCIP. And this is a nice little chart here of the aggregated token transfer. And so what this red one is, this is this USDC that we talked about earlier. And this is the CCIP aggregate tokens transferred, the total number of tokens transferred. This is at the beginning of the year in April, right? This is just a random day in April. They transferred nearly $6 million in USDC. And that looks like per day, this USDC is the number one asset that they are transferring. Again, another 5 million, another 3 million, another 2 million. And so this moves, all down the line. And today we can see a little bit less of USDC being transferred, but there's a lot of Go. Go, I believe, is the token for, I want to say it's the spin-off of the Aave protocol. That is what we see there. Go is a decentralized over-collateralized stablecoin. So again, another stablecoin. So with that being said, we can see that USDC is being sent cross-chain. We then also have Go, another stablecoin, being sent cross-chain. WETH is wrapped ETH. It's just a way to send ETH cross-chain. And we do see Link is some of those tokens being cross-chain. So a large part of CCIP is sending stable coins cross-chain right now. And that makes a lot of sense. People are wanting to send dollars cross-chain so that they can either trade or buy with them. And they're not going to lose a lot of value by sending them cross-chain. Additionally, it would not make a lot of sense to send non-stable coins cross-chain, because once you move, let's say, Bitcoin to a chain such as Cardano, what use is that Bitcoin going to have for you on Cardano? It's not based in Bitcoin. It's based in ADA, the token on Cardano. But if you send US dollar, you can still purchase a lot of different assets on the Cardano blockchain using those USD stablecoins. Here we can see the cumulative USD token transfer, as well as the logs for everything that is ever transferred on CCIP. So we can see most recently, US dollar, there was 8,000 USDC transferred today even, and that is pretty cool. Here you can see the total transferred USD volume by token symbol. We obviously know USDC is number one with $215 million since CCIP went live, transferred across the CCIP protocol, and then Go is that second runner-up with 60 million. And then here's just a little bit more information about CCIP, how many fees are being paid, or how much in fees are being paid in US dollar, how much are in Link is being paid. So Link, again, is the token that makes all this possible. You have to send Link to these oracles, to the Chainlink network, to be able to use the CCIP. And there's been 22,000 Link paid and used in this process, which results to roughly $1 million in fees paid out to these Oracle providers. It's pretty cool little dashboard. If you ever want to go check it out, go type in Chainlink CCIP at Dune Analytics. I believe they're just Dune now, dune.com. And you can see all this for yourself and really dive in deep to it. All right. So what we want to see now is we're going back to the article that I talked about earlier, bringing capital markets on chain with DTCC and Chainlink. I believe the DTCC is a market maker. Yep, the Depository Trust and Clearing Corporation, advanced solutions that help market grow and protect the security of the financial system. Let's go here. The DTCC is an American financial services company founded in 1999 that provides clearing and settlement services for the financial markets. When the DTC was established in 1999, it combined the functions of the DTC and the NSCC, which is the National Securities Clearing Corporation. The NSCC is currently the subsidiary of the DTCC. And what clearing is basically when you send a bank transaction, even outside of a bank transaction, if you were to just send your friend Venmo or something, right? With these large amounts, Venmo is probably not the best example because it's a closed loop. So, excuse me. What clearing is when banks send money to one another, they're actually not sending it immediately. They're sending communications via SWIFT. So, hey, I owe you $10, you owe me $5, I owe you $20, you owe me $7. And because they're little transactions like this, they're not going to just send 7 here, 10 there, and go back and forth. They're actually going to settle this at the end of a period. So either at the end of the day, at the end of the week. And what these clearing companies do is they make sure that the assets being sent back and forth are legit and that the banks have these assets. So they are being cleared for transfer. Think of it that way, right? When you get on a plane, can you be cleared to board? These transactions are being cleared to be transferred, and then you have a settlement company at the end, which is then, hey, this is finalized. We are going to settle this transaction. So they even say this article was written a year ago. It is increasingly clear that blockchain technology is likely here to stay. Let's move this over so you guys can see it. It is increasingly clear that the blockchain technology is likely here to stay. With 90% of institutional investors anticipating tokenization, 90%. Tokenization will evolve asset management processes and $100 trillion worth of assets in the U.S. that could someday move on chain. We are already seeing this now, as we saw with what Chainlink is doing with Swift. They are trying to bridge the current financial system with how it is operating today to the new financial system that is on chain. Rather than embarking on a wholesale rebuild of existing capital markets infrastructure, financial institutions are increasingly collaborating with innovative Web3 technology platforms like Chainlink to explore how capabilities can be embedded into their existing systems where possible to accelerate the real-world impact of blockchain technology in the global financial system. If you recall, it is increasingly more difficult the more that we go into the future, the more that we produce these systems to then link back into older systems, because we are widening this gap. So it is super important for us to make it backwards compatible with the current financial system. That way the impact can be that much greater, and we can grow that much more exponentially going into the future. If you recall, it is not the easiest thing to plug into an old system. And so what Chainlink here is going to do, as we'll see with DTCC, and what we've known that they're doing with Swift, is bringing the new financial system to the old financial system and allowing them to interoperate and communicate with one another. So the DTCC and Chainlink collaborate on Swift's blockchain interoperability project. Again, this is the project that we've gone over before, which has now been fully tested in that test phase. As a premier financial market infrastructure provider, DTCC automates and standardizes the processing of financial transactions, mitigating risk, increasing transparency, enhancing performance, and driving efficiency for thousands of broker-dealers, custodian banks, and asset managers around the world. One of the cornerstones of success for DTCC and other major financial market infrastructure providers like Swift has been the establishment of industry standards that allows a multitude of financial institutions operating on disparate systems and in different jurisdictions to conduct business in a secure and efficient manner. What this is saying is that the DTCC currently automates and standardizes the processing of these financial transactions. So again, they are clearing these transactions. They are looking at, hey, does the bank have enough? Can we do this? Is the bank a reputable enterprise? Are they one that we've worked with before? And does the place that they're transacting with, does this all make sense? Is this blasé? Is this something that they can move forward with? And so what they like to do is they like to automate this so that there's no human interaction unless something's flagged, unless money's moved on a larger scale. And so what this means is when they're clearing these transactions, they have to work with Swift because Swift is the one that's messaging these transactions back and forth. So you have Swift where the banks are messaging each other back and forth. And then you have DTCC, which is saying, okay, we see those messages. Let's go in and make sure that these transactions are legit and that we can clear them. And so what Chainlink is now doing is taking all of that. Okay, we see your messages, we see your clearing, but let's bring that on chain. Let's make sure that when something's cleared and it's finalized, that those results are shown on chain. Let's make sure that when you guys are communicating that we're replicating all of this information across different chains so that if someone's sending money from a different country or someone's sending money from their private chain and they want to bring something on chain to their wallet on chain so that they can go into a DeFi market, that the DTC has clear visibility to all of this and can still work as they're supposed to outside of the confines of the traditional payment system. Swift's project explored standardization and blockchain interoperability by showcasing how financial solutions and FMIs can utilize their existing Swift connection in combination with Chainlink to instruct the transfer of tokenized assets across public and private blockchains. Chainlink CCIP was used on the back end by Swift to facilitate secure cross-chain messaging and token transfers, while DTCC served as a token issuer and central securities depository. So what this is saying is that CCIP was used on the back end by Swift to make sure that the transactions across the different chains are cured securely. As you recall from the stream where we read and researched how this is currently working between Chainlink and Swift, that is exactly that. Because Chainlink is relaying these messages just like they would with an Oracle with these data feeds, Chainlink is doing the same thing with Swift. They're saying, hey, I want to see your messages. I want to relay this message to the other chain so that they can see what you guys are saying to one another. And then what DTCC is doing is they are issuing tokens and acting as a depositor because they are minting and issuing these bond tokens, which are interoperable with CCIP, and distributing them to Swift's designated test wallet. So in this situation, this is just a test scenario. But essentially what it is saying is, okay, DTCC is going to act as this intermediary of transactions. So, okay, we're going to see that you want to send this to one another. And so DTCC is in saying, okay, we're going to issue this bond because you want to send $10 from your account in the current financial system off-chain to a blockchain. And so we're going to be this intermediary and clear this money. You're going to send us 10 and then we're going to issue this token to you on the blockchain. Our involvement in Swift's blockchain interoperability project underscores our commitment to staying at the forefront of FMI innovation and creating new opportunities for our clients to optimize their financial operations and achieve new value via digital technologies. This is a nice, very nice graphic that we can see here. What we see are financial institutions, the Swift SDK, the MT. So don't worry about what all these acronyms mean right now, but what you can see is that you have these financial institutions that are sending signed blockchain messages to Swift. What Swift is then doing, it's going to relay that information, that signed blockchain message and the metadata to the Chainlink cross-chain interoperability protocol, the CCIP, have this blockchain interaction occur, forward that back to the CCIP. They're then going to route all this information on a separate CCIP interaction to then move that to the other blockchain and then work backwards again. So then they're gonna have the financial institution send that via message to CCIP. CCIP is then going to take that message, make sure everything occurs, make sure that the new destination blockchain gets that message and gets the assets, and then work backwards so that, okay, we have the assets, send that message to the new financial institution. Swift is then going to translate that and move that back to the other financial institutions' repository. So unlocking capital markets interoperability. In recent years, it has become increasingly clear that FMIs like DTCC can play key roles in delivering robust connectivity to and across blockchains. Our desire to explore this capability led to a series of conversations with the Chainlink Labs team around how CCIP could potentially serve as a universal gateway for interacting with blockchains for new and existing back-end systems. Following the successful collaboration on the Swift project, it was a success. DTCC has begun work with Chainlink to explore additional opportunities for blockchain technology within capital markets. And so lastly here, they say, together with the largest players in the financial industry, DTCC sees an opportunity to enhance the way financial data flows across the industry and how assets are settled across capital markets, bringing the benefits of blockchain technology to life. So, as a summary, what this means is that Chainlink is allowing banks the ability to bring assets on chain. Their current infrastructure does not allow them to do this. And in the future, one of the hypotheses that many crypto advocates believe is that these banks are going to have their own private blockchains, right? They can control everything that goes on in the private blockchains. They own what goes on. They are the only ones who can see what goes on, and they can have their customers interact in a very efficient and honestly cheaper manner. But when they want to move assets off of these private blockchains onto either other private blockchains, so to other banks, or onto public chains, they are going to need something like CCIP to be able to do this. And Chainlink is really stepping up when it comes to this with their development, with their products, to allow these banks and other financial intermediaries to begin to bring and bridge on chain. All right, so that was that one. Let's give permission here. All right. So next up we have the let me bring one up. Let's do tokenized real estate because I want to leave the TCP IP to CCIP. I want to leave that discussion for when we actually talk about the current internet stack, right? A lot of people don't know that there are layers to the internet. And so really when people even say layer 2 to blockchain, that's really a testament to how it's really an upgrade from the existing current stack of how things currently work. It's not anything new. So what is tokenized real estate? Tokenized real estate is when a real estate property or its cash flows are represented as a blockchain token or tokens. So imagine this. Today you currently buy a house and you do have all these intermediaries that allow you to purchase that house. You have an escrow, you have a title company, you have all these different things, and your deed and your house title sit with the current county or the state, which is fine. They can be the ones who are in charge of that. But unless you are going out there and making the effort to request this information, it's a lot hard to find it, right? It's a lot hard to see what's going on, who was the prior purchaser. You can't really see who it's changed hands from, and that's okay. You can. Some things are meant to be left private, but tokenized real estate allows people to transact digitally and not have so many intermediaries in the middle of this transaction. And so once something's finalized, you can own the deeds, you can own the titles, all within the digital landscape. And so as a token, right, this would be the actual ownership of the house. You'd own it on the blockchain. But I think the coolest part about this is when they say tokens or the ability to have multiple owners of a house, right? So right now, companies can go buy a house. They have to create a company, a structure for investors. But if I was a crypto real estate company and I wanted to buy a real estate asset for investments, I could buy a house, let's say, for $300,000, and it's me and two other investors. So there's three of us. I could create 3 tokens that would show 33% ownership for each investor, and thus each person has one of those tokens in their wallet. And so right now, that's a lot more efficient than what we're doing for current business investment ownership of real estate. Additionally, we can tokenize the returns on this real estate. So let's say I'm a company and I don't want the asset on the blockchain, but I want the revenue stream to be on the blockchain because that's how I'm going to get investors to invest. And so I could say, okay, again, let's have 3 tokens for a house, and I own the house, but I want you guys to have equal 33% ownership in the revenues of that house. So you're not necessarily owning the house, but the revenues of the house. What I'm then going to do is I'm going to sell these tokens to people, and let's say there's renters living in the house and they're paying, again, $3,000 a month in rent. These tokens are going to allow investors to get the yield from this rent. So let's say I'm not keeping anything for myself. $1,000 in API would go to each investor, each person holding that token. So it allows us to really change the way that we are doing real estate investing. In 2021, the global real estate market was valued at $29 trillion, making it one of the largest markets in the world. The vast majority of people around the world are connected to the real estate market, whether as renters or owners or as office, retail, or factory workers. Compared to other assets, real estate is illiquid and inefficient. It can take weeks to months to find a counterparty. Sales prices fluctuate within a range. Real estate transactions take weeks to close. Many service providers are needed to transact, and overall, this process can be streamlined and unlocked through tokenization more so than what is going on today. So, what is tokenized real estate used for? Tokenized real estate is when a real estate property or its cash flows are represented as a blockchain token or tokens to increase liquidity, streamline processes, and enable digital ownership. Again, you can have a single token to represent ownership. You can have multiple tokens to represent shared ownership, or you can even have multiple tokens to share cash flows from a property. Again, sharing the rent of the families or the people living in that real estate asset to the investors and providing a yield to investors. In general, the use of blockchain technology for tokenized real estate requires the use of either non-fungible tokens, NFTs, or fungible tokens, depending on the goal and what's being tokenized. NFTs are useful when a property or group of properties is being considered as a whole, one or more properties, one token, or fungible tokens are useful when fractionalizing a whole into parts, one or more properties or 100 tokens. Again, if you are the sole owner and your house is unique and it's just that house, you are going to use an NFT. You only need one token. No one else can own that. It is non-fungible. Or if you are using tokens to represent multiple investments or multiple houses in a portfolio, or you have multiple investors for one house or want to sell the yield on a house, that's when you would use fungible tokens. According to KPMG, another large firm, tokenization is Ideal for owners of a single asset or small portfolio of assets due to the significant reduction of time and cost in offering the right to participate in fractional ownership and subsequent secondary trading. How could tokenized real estate work? In general, tokenized real estate requires that there is a firm, trust-minimized link between the digital asset and the underlying physical asset. Chainlink is a Web3 services platform that supports developers and entrepreneurs aiming to bridge the gap between blockchains and real-world assets by providing best-in-class connectivity tools. Now, there is no way to get people to just start using this all of a sudden, right? To get people to start using Web3 as their main source for tracking their ownership of real-world assets is not going to happen overnight. But as we see with Swift and as we have seen with the DTCC projects, something like CCIP could work with state and government systems. So Chainlink could plug into state or federal ownership systems, property appraisal software, property purchase software, ownership software, and integrate with that so then it's on the blockchain. And then likewise from there, these ownership propensities could really spread out from there. And now the question comes into play, right? Is this going to be on a specific blockchain? Is it going to be allowed on multiple blockchains? I think that's yet to be seen. If CCIP does show to be as robust as it is, I don't see a problem with it being cross-chain. But I think with assets such as housing, they're going to want it to be in one place so that everyone knows where to go and that nothing's lost. Simple tokenized asset. The simplest example of tokenized real estate is representing a single real estate property as an NFT. An NFT is a unique token that is verifiably different from every other token on a blockchain, making it a good fit for real estate because every property is different. The features of this is that owning the NFT can be equivalent to owning the property. Transferring the NFT can make a change in property ownership, and the NFT can hold critical data such as past sales, address, or more. Again, this is going to be massive when it is adopted. So you can send ownership via a transaction on the blockchain. You can see prior ownership on the blockchain. And you can also see, probably like a car, if standards become to that point of when was it updated, when was the roof updated, when was the kitchen remodeled, when were all these different permits put into the system, just like you could go onto a property appraisal website and see when permits have been published. See it all in one place and see everything that you probably can currently see on a property appraisal website all in one place on the blockchain. Dynamic tokenized real estate is a little bit different than the single tokenized real estate. The dynamic tokenized real estate is dynamic NFTs are NFTs that automatically update their data based on relevant conditions. For example, replacing the house's roof, as we just mentioned. So owning the NFT can be equivalent to the property. Transferring the NFT can make a change in the property ownership, and the NFT can hold and automatically update critical data. Again, this would be something such as the relevant conditions, or even what is the current price of the house. As we know with CCIP, they can bring assets across different chains, but Chainlink's base solution, what they currently provide is an Oracle network. And so with these oracles, they can go out and get this price information for a house, whether from Redfin, whether from Zillow. And while it might not be the most accurate because those companies are subject to their pricing algorithms, we can have that dynamic pricing model put into this NFT so that anyone can go on and see everything about the house immediately. Next, we have fractionalized real estate. A compelling use case for real estate tokenization is fractionalization, or enabling fractional ownership of a property. This approach uses fungible tokens. Fungible tokens are just indistinguishable from one another. An existing example of fungible assets is stocks. One stock is always equivalent to one another. Okay, so this visual does a great job of explaining fractional ownership. Imagine that you are a company and you have bought a house. You have $100,000 in this house and you're saying, okay, now that I bought this house, I want to get investors on board so that I'm not the sole owner of this house. And what you do is you go find 9 other investors that pay you $10,000 for this $100,000 house, And now there's 10 tokens out there, each owning 10% of this house. So you own 10% and these 9 other investors own 10%. And the way that this ownership is divvied up is by these tokens held in their Web3 wallets. And that way, everything can be seen by what wallet, who's owning what, and how many tokens do they hold elsewhere? Are they are they more likely to do certain things because you can see what's in their wallet? And so fractional real estate ownership unlocks access to the real estate market in a completely novel manner. With the right decision, fractionalized real estate tokens could allow savvy investors to build custom-made portfolios of different real estate's assets. Next, we have this tokenized real estate cash flow. With blockchain-based tokens, it's possible to separate the cash flows, as we said before. Again, this is another feature of tokenizing real estate. So the cool thing about tokenizing the cash flows is that now you can make an investable asset, kind of like a REIT. A REIT is a portfolio of real estate products that you can invest on the stock exchange, that you then get some yield from those real estate assets. But we can get more granular and tokenize actual individual real estate assets. So in this example, there's a house, and that house has an NFT. And so while that house NFT is owned by somebody else, they're going to create tokens based on the yield from that house. So if a company owns the house, but they're owning, if a company owns a house, but they want to tokenize the yield on that house, and they're charging $3,000 in rent to the people living in that house, they can then tokenize that yield. And let's say they want to give that yield back to all their investors, and they have 3 investors. Well, if they're charging $3,000, they can make 3 tokens and give those tokens to those 3 investors, so that each investor owns a third, and they would earn $1,000 a month from just simply owning the cash flow. They could buy these tokens up front. So, okay, hey, we'll give you $10,000 for one of those tokens, knowing that that token is going to generate $1,000 a month. And then you have tokenized real estate baskets. It's possible to create a tokenized representation of a basket of real estates. Again, this is similar to a REIT, but just on the blockchain. And so you can have individual people buying and selling the right to a basket of different real estate assets. So by connecting real-world data sources to the blockchain, Chainlink helps provide a robust link between asset-backed tokens and their underlying collateral. What are the benefits to tokenized real estate? There are multiple benefits, but again, the main ones are you have increased liquidity, you have people buying and selling these tokens at a fast and efficient rate, you have better price discovery because things are more real time, you can have things more readily available when updated automatically on the blockchain. You have lower costs because of this efficiency, so when markets are acting at an efficient manner, it lowers the overall costs of transacting, and you have less people in the middle taking fees. And then you have reduced fraud because everything is finalized and verified on the blockchain. So what are some of the technical challenges of real estate tokenization? The reality is that widespread adoption of tokenized real estate is still some way off. There's a lot of, not red flags, but a lot of questions that people have. And while there have been a few attempts to tokenize real estate, none have yet been able to create a scalable solution that solves the problems and limitations of the real estate market today. So first off, you have data authentication validation. With things like a house, you don't want someone being able to, go in and change the price and lower it so that they can, outbid you. You don't want someone to make a fraud claim that they own a house. So that is definitely first and foremost number one. The biggest issue would be fraud. Number two would be wallet recovery. This is also a big issue because let's say the wallet gets hacked and they send the ownership of a house to another wallet. You can't get that back. No one is the final say or doer on the blockchain, so that would then be gone. So they really need to protect and make sure that everyone using tokenized real estate assets are able to secure and make sure that nothing happens without their consent. So number one is the data authentication and validation. Number two is the wallet recovery. And number three is implementation at scale. With a lot of users, you need to make sure that everything works seamlessly. And with such valuable assets being transacted, a lot of them being people's residences and people's livelihoods, you need to make sure that this is implemented at a scale that is sustainable, widespread. And so, as a conclusion, real world asset tokenization is an exciting opportunity for Web3 technology. And today there's already a wide range of different assets being tokenized on chain. As we know, there's stable coins. These are tokenized real world assets, real world dollars that are tokenized on chain, as well as other stable coins like the yen, the euro, and even gold tokens and carbon assets, right? They're tokenizing the means to transact carbon assets. So if there's one thing that I think needs to be taken away from this, it's the way that real estate assets can be tokenized. And again, we're going to go over this one last time because I think that these visuals do a great job of showing this. So number one is we have, sorry, let me go find it. Okay. So there are essentially 4 different ways that we can tokenize real estate, right? There are 4 different ways that we can tokenize real estate. What am I doing? There are 4 different ways we can tokenize real estate. There are 4 different ways we can tokenize real estate. The first way is a simple token, right? That is a token that is equivalent to the ownership on a house. That is the simple way, a simple NFT. The second way is a dynamic NFT, which is going to be the tokenized version of a house, but is going to come with all the other collected data. So when was the house updated? When were certain permits filed? What is the price of the house? Anything that you currently can do off-chain, brought on-chain. The third way that we can tokenize real estate is by tokenizing the cash flows of, I can't talk right now. So there are 4 ways that we can tokenize real estate. The first way is a simple tokenization of real estate, which is just going to be tokenizing the asset of the house and bringing that contract on chain to show ownership of who owns that house. The next way that we can tokenize real estate is dynamic tokenized real estate. And what this is it's a dynamic NFT that's going to not only be the ownership of the house on chain, but also bring in other important data points relevant to that house, such as when it was updated, when permits were filed, the price of the house, you name it, and that will all be on chain. The third way that we can tokenize real estate is fractionalized real estate. What this means is that we can break up the ownership of the housing asset. So we can have multiple people own a singular asset and break it up into multiple tokens. That way, as you see here, we can have 10 different investors owning a single asset and not have to go through any intermediaries to do so. It's all done on chain. And then lastly, we can have tokenized real estate cash flows, which is tokenizing the yield from these real estate assets. And so if you have a house and you have somebody owning that house, let's say a company owns that house and they want to generate a yield for this house for their investors, they can sell that yield as an investment product to investors and then give them a percentage of that yield, so that if this company's getting $3,000 in rent and they want to give $2,000 of that back to their investors, if they have 4 investors, they can make 4 tokens, and thus each investor would get $500 a month in that yield. So this is showing that there are multiple ways to tokenize real estate, and bringing real estate on chain is going to provide so much visibility to the real estate market and housing market as a whole. So that is all for today. I really want to thank everyone for tuning in, even though there is nobody, but definitely go check out Pear Does on YouTube and TikTok if you haven't already. Go check out the shorts, go check out the short form video, and see you soon. Deuces.